You're still on 20-25%, 22% cash, right? What will be that level or stage where you would say that now it is time to be 100% invested? Although we know that it's a gradual process. It's not like one day you wake up and say I'm going to invest today.
So if something really attractive comes our way, and looking at the sector and company exposures, typically we wouldn't mind buying up to 5% of our corpus in one company. Now, if let's say 4 good ideas come my way and I invest 5% each,
right,
the 20% cash can get deployed very, very quickly.
Right.
Now, it may sound strange right now, but such things have come about. So, in COVID, for example, in a month we deployed 10% of our corpus.
Right.
End Feb 2020, we were at 12% cash. March 2020, we went down to 2% or 3%.
But that was a significant market erosion, right?
Either market erosion or for some reason or the other, these kind of things happen. So, we never know the approximate cause, but markets do what they do. So, we don't start out with a target cash percentage in mind. How soon we'll be able to deploy would depend on the opportunities that really come our way.
What is on your watch list now?
I can't tell you that, right? I can't.
Okay, at least tell me themes or or some pockets that look to be in the vicinity of what you would like to buy.
So broadly, the pockets where things are cheap are largely in the traditional PSU value kind of thing, and those are plenty. But there's only so much exposure that you would want in that space. So cyclicals like, let's say, shipping companies or the oil marketing companies, these look cheap on price earning ratios, dividend yields, price to book kind of thing. So, but there's only so much that you can have of those. So buying has been sporadic based on individual company factors. Broad spectrum across sectors where things are cheap, I think there's only one, which is the financials space, where as a sector, private sector banks are our largest weightage in the portfolio. That is one space where across the board things are looking reasonably attractive.
Retail loan book may come under threat because of the job situation, especially tech job losses, etc. Do you think it is a significant risk?
There will be a wide variety of loan books out there. So it's like that saying, you can drown in a river which is on an average only 3 feet deep. Right? At some places it may be 10 feet deep, and somewhere it is only maybe 6 inches deep. So if someone has completely unsecured loan book to subprime borrowers or borrowers who have multiple loans from multiple NBFCs or banks, then obviously exposure would be something to watch out for. But if you have given unsecured loans to people with very, very stable private sector jobs or government jobs, where the bank also has a salary account for that person in their bank, then risk may not be that high. So I would not paint every company with the same brush. It is something to watch out for.
What do you rely on? Because, to assess the risk of a retail book for a bank is far more difficult than assessing the wholesale risk.
It's relatively easy. So it requires half a day to 1 day talking to direct selling agents, saying what are the practices of various banks, which banks have the least rejection of the applications, which banks want your best customers, which bank are yield hungry and will want your worst customers. It's known to the market. I don't think anything is hidden in that sense. Some banks will be very particular on loan to value. Some people will not be. Some people will want only a particular type of income profile. Some people will not be particular. So you get to figure out the underwriting processes of players by channel checks.